Everybody. Good morning. Let me go ahead and get started. My name is Trevor Cornwell, and I'm the founder of a company called Embarkons. And Embarkons was started with a very simple premise to connect good ideas with people who are interested in participating and funding them. And what we've kind of developed to be over time is an advocate and an evangelist for what we're talking about at the conference today, which is peer financing. And the essence of peer financing really is that rather than just going to the one person, to that one guy on Sand Hill Road, or waiting for that one introduction to an angel investor, that there are other ways of getting funding which may come from the person to your left, from the person to your right, person behind, the person in front. And this morning is really about sharing with you some of the best ideas and the best practices around that thinking. The way the morning's organized is we're starting out with a panel called the First 25,000. And we'll have a number of different speakers giving a number of different approaches to how you put together that first 25,000, and probably just as importantly, what you do with it. Because we all know people who have raised money and raised money again and raised money again and don't achieve their objectives. And it's really important to make sure that you're using the money that you raise efficiently so that your valuation is going up and that your business is getting stronger. We're going to talk about some interesting ways, I think, to approach that. The second panel is called Available Alternatives. And there we're going to look at, once you've gotten your idea up and started, how do you get from 0 to 50? How do you get from the product that you've thought of, the prototype that you've developed, the business plan that you've written up, to a place where you're really ready for prime time? We're going to look at a number of different things, from incubator models to crowdfunding, and really try and explore some different approaches. How can you find smart money from people who are nearby? How can you leverage mentors? How can you leverage resources that are probably proximate to you? The third panel that we're going to do up here is called The Future of Peer Financing. And here we have a really interesting group of folks who are going to be speaking about what's coming down the pike. And I think you're going to find that interesting. We have a number of people who have participated in the PayPal X challenge that have come up with really interesting and innovative business models. And I should say, for disclosure, we have also been a participant in that competition as well. We'll have a number of other speakers that we'll talk about during that panel, who will be talking about what's worked in other countries. We've been so focused here on having a sound and strong economy up until last year that I think we've lost sight of some very effective models that are working elsewhere. So I think in some cases we're going to find that the future may already exist, but it may exist elsewhere. In the middle, we're going to have two presentations. I'm going to go through and give a little preview of what we're working on with appbackr, and the folks from PayPal X are going to talk about their very exciting set of APIs. And I say very exciting, not in that sort of gratuitous way that people who stand up putting together conferences do, but because they truly enable a set of things that weren't possible yesterday. It's a very simple notion that one payment can be distributed to multiple parties, and you'll hear at that presentation how a number of people are putting those to use in very interesting and effective ways, and I think you'll find it interesting. I put thanks on the cover of the brochures that you have, the schedules that you have, and I want to just underscore my thanks again to the people who have participated. Sun Startup Essentials has been instrumental to me in supporting me in my business. They're now part of Oracle, and that program will evolve and develop and grow, but they've been a terrific group. And there are others that are out there along these lines, but it's one of the things that I would really suggest to people to try and take advantage of companies that have an interest in your success, because the ones that do, I think, are the ones that are most inclined to really get some skin in the game. PayPal-X, I went to their Innovate conference in November. I found it really, really inspiring and exciting. We ended up developing a whole business model around their APIs, and I just think there's a great community of people, who have participated in the challenge, great set of developers. I think you can really look to them for either to develop an idea or to look on x.com to find some really interesting models, some of which aren't here today, that may be helpful in funding what you're trying to do. And I also want to thank the law firm that we've been working with, which is also one of the sponsors, Cooley Goddard. I met with a lot of law firms along the way before making a decision about who to go with. And you need a firm that will roll up their sleeves and really get involved with what you're doing. And I say this as an entrepreneur, that I think you just can't do any better. And I know Greg is here today. If you're in the middle of starting a business, thinking about it, a conversation with him, I think, is worthwhile. So that's it for the thanks and the promotions. I wanted to do that at the beginning. They're heartfelt, and I hope that the people who are involved today can become resources for you. So we have a full agenda today. We're going to keep on schedule because otherwise we'll end up losing something at the end. We have a little bit of time for questions at the end of each panel, not a lot. But we have a really, I think, interesting working lunch, which Robert Clegg is going to be putting together at the end. And the idea is that after you've heard all of these ideas this morning, we want to get you grouped by your vertical, whether you're an app developer or whatever your designation. I think everybody had a card that they filled out at the beginning. We're going to get you grouped, and we want to hear your ideas about how we can take some of the thinking today and possibly put that into products, either ones that we develop or ones that you develop, or suggestions or best practices. We'll Twitter those so that we can talk today and beyond about best practices that can help your businesses grow. So I hope that you'll all stay and join us for lunch. So we'll get started. The first panel is moderated by Laurie Lumenti Garty from Silicon Valley Bank. Probably know of Silicon Valley Bank if you've been working in the area here. They are an extremely supportive institution for entrepreneurs. Laurie's been very personally helpful to me in developing the efforts that I've been undertaking. And she has a great perspective in seeing a lot of businesses. So there's, in my view, no one better to get us started this morning. So, Laurie?
Thank you. So I'm going to ask the panelists to come up and join me. And I just want to open by saying it's really a pleasure to be here this morning. So during the course of my career, I've seen hundreds of startups, and I've worked with hundreds of startups, and it's always great. I'm proud of putting this together as a way of trying to help all of you to create companies. So a little bit about me. I'm in SVB Capital, actually, and I manage the bank relationships with angels, universities, and incubators. And so I think of my job as really focusing on innovation and mentor capital and trying to bring the two together. And this morning, we're going to talk about probably the most difficult amount of funding you're ever going to raise, which is that very first $25,000, and it's usually around the time that you're taking your concept and trying to move it forward. So we're going to try to dispel some of the myths around fundraising, and we're going to talk about some of the more creative ways that entrepreneurs have to initially raise that $25,000. So we have a really wonderful panel here. We have a mix of both. I think everyone here has been an entrepreneur in their career, so you have a wealth of entrepreneurial experience as well as some folks that are actively investing. And so it's going to be wonderful to get their perspective. Before I have the panelists introduce themselves, just out of curiosity, how many of you are raising funds now? Okay. How many of you have already raised your first 25,000? Okay, how many of you are embarking on that daunting 25,000? Okay, so this panel is going to be relevant for most of you. So I'm going to start here and introduce each of our panelists. Have each of them introduce themselves, actually.
Hi, I'm Eric Klein. I have been around the Valley a little while, I guess, both as an entrepreneur and more recently as an investor. I've started 3 or 4 companies. I've worked in startups for SoftBank, Kleiner, Sequoia, and I also worked at some of the bigger Silicon Valley companies. I now run a small angel firm, basically me, myself, and I. So I am the first 25,000 for a number of companies in the Silicon Valley. And I'm also actually starting a social gaming startup right now as well. So I'm investing and raising at the exact same time.
Very good. Hi, I'm Chris Gill, President and CEO of SVB, the Silicon Valley Association of Startup Entrepreneurs. So you can probably tell I'm a Brit. I've been here for about 16 years. I've been co-founded 8 startups and over the last 35 years, and been a member of Sandhill Angels for the last 6 years, and we launched a seed fund program in conjunction with Cambridge West Ventures at the start of February. So that's our story. Oh, you've already got one.
Can you hear me? My name is Mark Daggard. I'm the founder of Entrepreneur Commons, which is a not-for-profit that provides peer support for entrepreneurs through small chapters of 5 to 7 people who meet on a regular basis and help each other. And these chapters are a pipeline for a fund that we are raising to provide financing to entrepreneurs for the first 25K. Actually, the idea is to provide the first $100,000 through that fund, through loans as opposed to equity, with a selection process that is a selection from the peers. So the projects are bubbled up from the chapters to be promoted to be eligible to funding from the fund. Personally, I've been here 20 years. I got into being an entrepreneur in 95. I started an e-commerce company, which was an opportunity for me to go around and talk to VCs and understand a little bit of the process there. I also ran an angel club for 2 years, European American Angel Club, which allowed me to understand how angels are doing it a little bit differently, but to me still wasn't the answer to what entrepreneurs need, which is why I started Entrepreneur Commons in May 2008.
Hi, my name is Ray Lau. I'm the founder and CEO of Playhaven. I actually just raised my first 25,000 about a year and a half ago, so can definitely relate to a lot of you guys. So what Playhaven does, essentially, we work with iPhone game developers primarily to help them sell more copies of the games. And whether it's to directly help them sell to existing customers, to like virtual goods, in-game purchases, or upsell their next game, or we actually help them on top of that to sell to reach new existing customers. And since we launched late last year, we have over 200 developers using our platform, reaching about 2 million mobile users, and growing rapidly. And any questions, we can talk more about that. But primarily, we actually we raised another seed round about a year ago, and so can definitely talk to you a lot about that experience.
Right. So why don't you hold on to the mic there? So you just raised your first 25,000. How difficult is it to raise, and why is it so difficult?
So I'm actually a first-time entrepreneur, and really that's a great question because it really depends on what your experience. If you are a serial entrepreneur, raising this, if you have a track record, proven track record, it's going to be easy. But as a first-timer, it's a little more difficult. We actually went a very different route. I'm not sure if any of you guys know accelerator programs like Y Combinator or Lunchbox Digital. So we actually we're the first class of Lunchbox. It's very similar to Y Combinator, essentially just 3 months program. And they give you approximately between about $15,000 to $20,000 for 3 months. You work with some really fantastic mentors. And for us, we applied to that kind of program, so it's kind of a different approach rather than going to your typical kind of angel route. At that point, it really depends on kind of person you talk to as well, I think, because these kind of accelerator programs is they are much more friendly to first-time entrepreneurs because they are kind of the target audience. So for us, I think it was hard, but by picking the right people, it's not as difficult.
Does anybody else have a different perspective on that first 25,000?
I have a question. I'm curious how much it did cost you these $20,000. I mean, because that's the big thing is getting $20,000 could be 30% of the company, or it could be 2%, or it could be a loan. I'm curious what kind of deal you got.
Sure. Great question. So these programs typically range. They usually give about 3 to 6%. I think some will take up to 10% of your company. And for Launchbox, typically about 6%. We negotiated down a little bit, so I can't really tell you the exact number, but that's a typical. And so if you think of the valuation at that point, I think it's about, if you do the math, about 200,000 pre-money valuation. But that's, a lot of people think that's really, really low. However, I'm going to actually say that's actually really, really fair for the reason that these kind of programs like Y Combinator, Launchbox, Techstars, they don't bring you just money. They bring you advice and connections. And for first-time entrepreneurs, that's extremely important. It's not the advice is that these are typically ex-entrepreneurs who have done it, who have proven themselves. So they come in to provide you with a lot of product advice, marketing strategies. How do you do business development deals? As first-time entrepreneurs, I don't know how to do any of those, and so those advice were really, really helpful for me. And additionally, it's most important towards the end, which is when they kind of organize pitch days, they kind of bring a lot of investors, whether it's early stage VCs or angel investors, around the valley together, and they bring you that connection to help you raise that next round. And I think that's extremely valuable.
Yeah, I've got a different story about how to get your first money. The first startup that I did fell into my lap, and I raised the first almost $50,000 from the first customer, which was, in my view at the time, the ideal way to do it, because I knew nothing about doing a startup. I was a 24-year-old engineer, computer engineer, who just moved into sales, and I didn't know much about either of those things. And I got the opportunity with the largest banking group in the UK at the time to provide one of their branches with custom printed checks. In those days, what you had to do was when a new client came in, you would take all their details and you'd send it off to a jobbing printer who'd take, well, I'm not sure about this, Gov, I might be able to turn this around in about 3 weeks if I really push it. And so it was horrible. And at that time, I could take a Motorola microprocessor development system, a Centronics printer. I could employ a programmer to program in BASIC, and we could do something that would turn it around in an hour. So they thought this was just fabulous. I said, okay, I haven't got any money, so I need to employ these people and get stuff going. Give me an order, give me the money, I'll get stuff going. If it doesn't work, you get your money back. If it does, you'll have a system. And they said, certainly, here's a check. Boom, get me the money. So no dilution, no loss of equity, nothing, absolutely nothing. That was a terrific way to start a company. Get $50,000 from your first customer.
Seems fair. So right now, actually, I'm tracking there's around 60 or so of these accelerator type programs around the world. So there's about 40 of them in the US and 20 plus outside of the US. So it's really becoming a very popular model. And of course, I know that you just launched a new fund.
Yeah, we did.
Maybe you can talk a little bit about that as a way
Sure.
to try to help.
So this is really quite interesting. As the guy nominally running S-Phase, there's actually other people that actually do it. I'm just the figurehead. There's this huge gap we're seeing growing between what you could raise as a first-time entrepreneur. You've already expressed how difficult it is to do that. Most VCs and many angels want to see proven teams and make them very, very difficult for first-time teams to get going. So we kept seeing this gap getting bigger and bigger. We saw the success that the Y Combinator and Techstars people were doing. We thought the equity trade was a little bit, a squeeze. They brought the valuation down to an all-time low. So we thought, can we do something that's a little bit more entrepreneur-friendly? and it's a more reasonable amount of money, maybe $50,000 to $100,000. And I went around talking about that for the last year or so. Nobody laughed at us. And in fact, several of the not usual suspects, so not the typical limited partners, came forward and said, if you can get a lead investor, we'll chip in $5 million. So before I knew where I was, we had $25 million lined up. As it turned out, we couldn't get a lead, but by pure luck, I met up with Ellen Salisbury, who's not here today, unfortunately, she couldn't make it, who is the representative of a very high net worth family. I'm not going to name them, but I can let you know that they have their own $200 million venture fund. So they are pretty high net worth. And her role for them was to do seed investing. She was from the East Coast, she just moved over here to start doing it, so she didn't have the network. SVBs and myself, we've got the network here. So we came together and we formed a seed fund program. And the basis of that program was to provide first-time entrepreneurs with $50,000 of seed funding to go from the idea through to proving that idea in the market to see if there's a good product fit, find out what your business model is, see what the size of the market is, blah, 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 blah. So we focused on mobile and consumer internet as areas where $50,000 could be a meaningful amount of money to take you to meaningful milestones. Is that enough?
Oh, that's great.
Okay.
So all of you that were looking for that person. So, I think it's really important to talk about the structure and terms. I've watched, how many of you have watched Shark Tank? The show, not that many of you, but sometimes you hear stories of people giving up inordinate amounts of their company for a very small amount of capital. But really and truly, what's normal? So, Ray, you spoke at, I think what the accelerator model is generally somewhere between 3 and 10% on the higher end. There are other ways that people can finance their companies. So customers are great, that's great. But then there's also friends and family, there's angels, there's other, sometimes there are institutional investors that are doing seed funding as well. So what's the normal structure and what can entrepreneurs be, what should they be looking at? What's rational?
Well, I don't know about you guys. I don't think there is a standard formula for this at all. If there is one rule, there isn't. And it really, I think it also depends on the type of financing you take. A lot of, I think there's friends and family, and whether it's friends and family or angel at the end of the day, it's money. But one of the big things I see is whether it starts as a convertible note or whether it starts as a true equity round. And for those of you who are, how many people are familiar with convertible versus, okay, so almost half. So convertible, basically, you're issuing a loan, with interest and sort of some preferred rates, potentially preferred terms in terms of you get a loan and you will pay it back when you raise your money, versus an equity round where you literally are giving up, a portion of your company directly to the investors. And convertibles are they're pretty simple to do, and they have an interest rate and some preferred terms. And then in equity, I think literally every deal looks different. My comment is I sort of have a similar sort of reaction. I think the Y Combinators and the Techstars, they're definitely fabulous vehicles, but you really have to understand what you're getting and what you're giving up, because you really do. The thing I would say is that the first 25,000 is actually really easy to do. There's just a number of different ways to do it, and you have to look at each of them, decide sort of what suit fits you best. A Y Combinator, you're going to get facilities, you're going to get mentorship, you're going to get a certain amount of money, and you're probably going to give up a little bit more in terms of that $25,000. Friends and family, you may be able to do on a favorable convertible note. And angels, I think, they, depending on what type, in fact, we were talking earlier, you can get an angel who wants to be very involved in your business. In fact, the mentorship is almost, they want to give you the mentorship as almost as much as the money, and that's how they protect their investment. And then there are some, more traditional models, I think, where they've got a syndicate together and they can get you a larger amount of money to get you going. So I don't think there is one standard term, but you hear everything from 4% all the way to 30%, depending on what you're doing in the early round and how much you're raising, and quite honestly, from who. So it's the thing I would say, and sort of before I hand over the mic, is The other thing is to network among yourselves and network among other first-time people who've been through once, because once you've been through, it's like a club. You start to understand what the terms are really, and you hear what other people did, and you'll find something over time, both the model and the investors, that makes sense for you.
Just a few things I'd like to say. First, you mentioned customer as a good way. I think customer is the best way to raise money. I mean, the money from customers, the beauty is it comes with no strings attached. So that should be number one.
Hello, I actually had to deliver a system. That was a string.
Sure.
Slight string.
But you don't have to deal with somebody who's going to mess around with your strategy or tell you what to do with this. So that's very important. The other thing is cost. The cost of transaction definitely for notes is way cheaper than the cost of term sheets and things like this. I mean, when I was running the Angel Club, I belong to the Angel Capital Association, and they're doing a very good job at helping angels share best practices. The sad thing for me is that the best practices are typically what the VCs do apply to an angel group, and you turn into term sheets for $100,000 or $150,000 worth of money with 8 guys behind, and it gets very complex. It takes forever to negotiate this, and it costs a lot of money, in the end. Plus, the other problem with equity is valuation when you're pre-revenue is anybody's guess. So it's basically me showing up and saying, you know what, here's my money, I want 30%, are you going to take this, yes or no? And the reality of valuation at that stage, I mean, $200,000, makes me very sad. I mean, I'm sorry, but you get a great program, that's cool. You get a lot of help, but you can get a lot of help from a lot of people anyway. And at the same time, $200,000 valuation doesn't make any sense. I mean, to me, it's ridiculous. I mean, if typically valuation is whatever money you produce or your profit times a certain coefficient, and it's based on the goodwill of how much value it is for whoever is going to buy. But I mean, $200,000. If you're going to make $2 million, 3 years from now, you're worth more than $200,000 already. So in this kind of valuation for me is a problem. That's actually okay. The last point I want to say is back to the convertible notes. You mentioned follow-up rounds to convert the notes. You may never need to have and you should shoot for never ever raise more than the first money. I mean, the statistics on that are Inc. magazine produces a top 500 fastest growing companies, a list of the top 500 fastest growing companies every year. The average capital to get into that list is $75,000. So it's not just high tech; it's everybody, and it's just an average, but it gives you a good sense of what it should take for you to get your business going. The average capital to get into the top 5,000 fastest growing companies in the US is $25,000. So when I hear people saying I'm raising $500,000, that's great, and maybe you need that, but you should always get rid of your preconceived ideas of what it is to take a business. Business school, sadly, they teach you how to do a business plan and how to raise money, and they kind of push you in that direction. But the reality is, it's not how you do it. The reality is, you have what you have today. You try to build your business with that. If money comes along the way, that's great, but don't systematically go after that. And you may not need as much money as you think if you're smart about how you do your business.
Yeah.
Go. No, please. Yeah.
Let me add to some of that. I've got some very firm views on this. And the things that I learned doing 8 startups and then being an angel is that you should be looking to acquire financing to get you to meaningful milestones that give you, as the entrepreneur, options. Options that do you, okay, I've taken $25,000 from friends and family. That's got to be the best place to get 25. That's got to be the first place that you go. unless you're extremely lucky, most of your friends and family will not be accredited investors, which means they don't have millions of dollars in the bank, they don't have more than 200,000 as an annual income for them. So in which case, don't let them take equity, because you'll screw up the cap table. You don't want to do that, do it as a loan. So that means, okay, you've got an obligation to pay that back regardless of what happens, but it's a very cheap way of doing it. And who's the people most likely to want to support you at that stage? Hopefully your friends and family. If it's not your friends and family, you've got a real problem. Because if you come to an angel and say, you know, I need some money, and we say, got your friends and family money? No. We go, that's a bit of a red flag, isn't it? Because at that stage, you're pretty much banking on you, so friends and family. Use that money to get to a meaningful milestone. Don't waste it just building a product that nobody wants. So try and do something, some way to test that it is product in the market, a good market fit, get the size of the market. That then gives you, once you've found that, some options. It might be the option that, this isn't a venture fundable business, but it's a nice lifestyle business. If I can get this up to $6 to $10 million revenue per year, I can take home, let me see, somewhere between $500,000 and $1 million. Okay, I can live on that, that's cool. So, you know, that's a terrific business. Don't get hooked on being venture fundable. Think about Ning. Mark Andreessen's left Ning, the CEO has left Ning. It's taken $120 million in venture capital. If you think that's brilliant, I think it's stupid. They've got nowhere else to go. They have to get over $1 billion exit, otherwise nobody's happy. They have no options. They can't have a lifestyle business. It's not possible. So that's what I would do at the early stages. Try and get to milestones that give you options.
Yeah, I couldn't agree more. And there's a milestone, when I look at things now, there's only one milestone that I look at. You know, we get these 3-year projections of revenue, and I love how many startups tell me, you know, I'll be at $50 million of revenue within 3 years or something, or some just astronomical number. Number one, the fog of war is just, if you can predict that, you know, I should be putting money into you for other reasons. The metric I'm looking for is cash flow positive. It used to be we would see things, it's like, I'm going to grow, I'm going to get a lot of users, and with those users, I'll figure out how to monetize it. That's an excuse now, really. There are very few businesses that can present that model and get funding. And I think a lot of it has to do with starting from open source and being very lean in doing it. Really today, and I think you're going to see presentations later on, in many businesses, your routes to actual revenue have the run time to get to that has dropped tremendously. If you're doing iPhone applications, if you're doing consumer applications, you should be able to make money on day one. You made money on day one, you know, with your first startup. Today you can do that in a huge number of businesses, and so I look to that. I look to the companies that I fund, and I say, how fast are you going to get to cash flow positive? AK, don't need me anymore, right? I want to see you hit scale, and if you're cash flow positive and you want to take money in, at that point you have options, and you're doing it because you want to accelerate your own growth. So I really do look to revenue and how you present your ability to get to revenue quickly as one of the key things that says, I'm going to give you that first $25,000, because I expect with $25,000 you will be able to, you know, literally frame the first dollar up on your wall, and many more behind it.
So what you're saying is basically you can't raise money on a PowerPoint or on an idea. The first 25,000, you really need to be a little further along.
Well, I think the interesting thing, and this has just happened in the last few years, it's been revolutionary in the sense that literally today, your cost to get a company off the ground is so low versus 5 years ago. I mean, imagine 5 years ago when I started, or I think it was 7 years ago when I started a company, we spent $50,000 just getting the server farm up and running. Now I turn on S3 for literally 45 cents, and I've got data flowing through the system. Office space around here right now, not too bad. Hungry people willing to work on sweat equity, available. The cost to get you started, and then more importantly, the cost, for instance, to bring in $1. I fire up a PayPal system. I fire up 9 different systems for advertising, virtual, microtransactions. There's 9 different ways for consumer companies to make money. So literally, your cost to make money, your cost to start your company are so low that when I look at $25,000, I say, you've got a fully functional company. You're bringing in revenue. within that window. So yeah, I think the interesting thing is, yes, companies do get funded on a PowerPoint presentation and an amazing team. But I look at them and I go, well, what were you doing at night? Why didn't you get to sort of a prototype or something? It is so easy to mock up what you're doing now and get it running and show me that you're capable of executing.
Sleep is not an option.
Never was.
On somewhat of a reality check on whether you are really resolving a problem, I think a good way to think about it for your business is, when you go see a doctor, you go see a doctor not so that he's going to fix you, but so just that he's going to take a look at you and tell you what you have, and maybe he'll help you. And you're happy to pay the $100 or whatever the doctor costs to just get that guy to look at you and help you. So if you have a business where in that situation where you can put your finger or something, and the customer can say, "Ouch," and then you can say, "I'm going to take a look at what you have, and I'll tell you how I can help you." You have a real good business, and that's how you can then find your first $25,000, either from that guy because he hurts so much that he'll give you the $25,000 like they did for you, or from somebody in that ecosystem who realized that yes, there is a problem, and maybe the $25,000 will make a difference here. But try always to think that way.
So Ray, I'm kind of curious to hear from you, with that 25,000, what kind of milestones were you able to achieve, and how far along did you get? Because you've been successful in raising additional funds as well, so, and I understand you're doing pretty well in terms of your customers.
Thank you. So to resonate, having a viable revenue model is extremely important, and I think that a lot of first-time entrepreneurs have this kind of hype train. Like many of those guys says, it's like, hey, let's just get to 10 million users, and then we can figure out a way to monetize. And that's probably the biggest mistake that you ever make. I actually made the same mistake when I first started off. We started to realize that it's a business. It's not a business until I start making money. Bottom line. Otherwise, it's a hobby. So you really need to figure out a revenue model very quickly, and very, very viable business model that the users or whoever the customer is will actually willing to pay for whatever you create. So to just wanted to resonate that. And second point, in terms of milestone-wise, I think it really highly dependent on who you raise money from, who you. But however, to kind of go back to the similar type programs, it's actually pre-seed. So a lot of things like Y Combinator, Techstars, these when you raise money typically from angels, they are giving you about pre-money valuation about 1 million to 1.5. That's on average at this point in time right now. And it's a little higher before, but market's not that great. So raising money is about 1 to 1.5. So the reason when you raise money from Y Combinator, Techstars, the valuation is lower because you don't even have a product at that point. They are really betting on a team. They're building out a product. So a lot of the times, the milestone coming out of these programs is really about having a product that's a minimal viable product that you can actually start seeing what users are reacting to. They are, how are they, perceiving the product, how they're using it. So that's really kind of a milestone that coming out of those type of programs. And at that point of time, then Y Combinator, Techstars, Launchbox, they will start introducing you to super angels or C investment funds to raise your next round of funding. So I think the value of these programs actually kind of put you in front of these, kind of really focus you on what is that product that that's so the core features that you need to build. Another thing that I actually, sorry, I'm kind of rambling on, is that a lot of entrepreneurs would have this amazing product in mind that they want to put in 20 different features into it so that they think it's complete. But a lot of times that these programs, what they do, working with program, working with Julia Jankowski, John McKinley, these guys, what they help you to do is say, guys, these are the core features that you really need to build in order for people to use it. So forget about this awesome, the PM system or this so and so real-time search. Just get something out that people will use. So I think that milestone-wise, for coming out of what I have experienced, it's really about viable product that people will use.
I mean, if you haven't read about the concepts of minimally viable product and lean startup, I really want to encourage you to do so. It is the future, right? as a venture person told me a while ago, they beat me over the head on my own business plan, was before you go horizontal, go vertical. AKA, get something small done right, and then I'll fund you going horizontal with the idea. So, come in with big dreams, but know how you're going to execute on the short. One thing I would add is, and I don't know if there's anyone in this audience sort of floating around, but there's this interesting thing where there's to your point, there's the Y Combinators, Techstars, folks like that. I funded a Techstars company just very recently after seeing them come through the program. I think there's this interesting thing where there's that, and then there's what we're going to call the super angels and the angel funds. In between and floating amongst you, let's just be really clear, in the Silicon Valley, there's been a number of people who've been very successful at small companies that went big, aka Google, Apple, and what we do is over time we realize that we want to help other people. And so we tend to float around these things, and we're small, we're one person, right? But we have done fairly well. And what we do is we look for these early stage startups. So I think there's the opportunity where, as you come out of Techstars, however you get your first 25,000, always be networking around the rooms, because you don't know who the person next to you really is. And a lot of times they are an individual who represents a small group of investors who aren't fully syndicated, or they haven't come together in a group, but they're looking for small companies to be an early investor, and that's what I do. And so I think the point I'm trying to make with that is, literally your first 25,000, there are 5 or 6 different unique ways to get it, and the key thing is you've just got to pound the pavement. In events like this, you can go to a combinator, you can go to events, however you do it, it's out there. There is no question. This is a great time to be an entrepreneur. You've just got to decide, again, what suit fits you best in terms of the deal you're going to get and the money you're going to raise.
So one of the things you mentioned is sweat equity. I want to, before I open this up to questions to the audience, is what's the right amount of equity to put up when you are bringing in people to help you? Is there kind of a rule to figuring that?
That's a great question. And
That's one, by the way.
I think there is no right answer for that. It's really dependent on your negotiation skills. So I think that it really drastically varies, and and also how it ultimately comes down to is how much you're willing to give up versus how much investors are willing to pay. So it's a supply and demand kind of issue. So ultimately there's no right answer for that, and I think it varies by basis.
I'll really quickly. I used to hear a rule long ago, and I really don't believe it's true anymore. It's just every time you take a round, you give up 30%.
Not investors,
Not
but sweat
investors.
equity.
Not
Sweat
investors.
equity.
Oh yeah, I'm going to go from the top
Okay.
and reverse
Okay.
around, right? So I think the interesting thing on sweat equity is whenever I start a company or I look at a company, the first thing you do is you pull their cap table, right? You look at how they broke up. When they start with the mythical 100% and no one owns anything. I think an interesting thing, as a side thing that I look at, is how they break between founders and employees. Right? There's sort of 3 pools. You're going to dilute, and you're going to give something to someone. You're going to keep a certain amount for yourself as a founder, and you're going to give a certain amount to your employees. I see this thing a lot where the founders are like, well, I'm going to keep 90, and then I'm going to see how it goes, right? I'm going to give 10% maybe, or 5% to the employees. I always look at that and I go, oh, no. Really, you've got to take care of your employees. And I look to to founders who realize that their employees and the growth of their employee pool is what's going to fuel their success, and that they've reserved enough there, and that they're holding on to a lesser share. Because if you're good and this is your first time, you will be back and you will make more money. But on the first time, you want to make sure that everybody on the table is well taken care of.
What numbers is that?
Well, yeah, I've got some views on this as well. But most entrepreneurs start out as, take a step back. Most investors look for teams. There's a good reason for that, because there's too much to get done with a startup to do it on your own. But most entrepreneurs start up as individuals. So first thing you've got to do is find a team member, at least one team member, to come along with you and drink the Kool-Aid and buy into it. And that's one of the tests that investors look for. Have you got an idea? Have you got the personal enthusiasm and leadership to attract somebody else to your idea, your startup? If you haven't, again, that's a bit of a red flag. But if you have, the first decision there comes, how much equity do I give this other person? Well, there's a couple of things to think about here. First of all, recommendation is don't form an LLC. An LLC tells investors that you want to be a small company. An LLC is a small company structure. 99.9% of businesses that get funded in Silicon Valley are Delaware C corporations. It doesn't cost much more to have that done. You should do it through a lawyer. You should not do it online. Online cap tables, the online legal notes are all wrong. Don't do it. They will screw you up. Go to somebody like Greg Clark at Cooley Godwood. Ask him nicely. If you do that, he may defer some fees for you. What that means is if you fail, you don't have to pay anything. But if you do get successful, then you do pay. And he will direct you to one of his team who will do that for you, Yellow SC Corporation. The other thing you should do at that point, if you've already got co-founders, everybody's equity should vest over time. It isn't yours yet, it should vest over time. You should want that. One of the companies that we were looking to invest as part of the first phase of the seed round, fabulous company, they'd come out of the Combinator program. They really wanted to move forward with it. They called up the day before they were due to come in and said, sorry, we can no longer go forward, my co-founders left. So what do? You don't want a co-founder to walk away with 20, 30, 40% of the company and do nothing. So that's why vesting is important. You should vest. If you attract a co-founder in, you're a sole entrepreneur, you get somebody to come in to work with you, and that person is on board to do specific things, like they're a CTO or even the CEO, then you can set vesting at particular milestones. So you have the potential to vest over time, 4 years, or at particular milestones. Highly encourage you to do that. Again, Greg Clark and his team can help you with both of those. It would be a good idea to have a 15 to 20% option pool right up front to help you bring other people on board into the option pool. These are employees. If you're doing outside consultants, find some other way than giving out equity. Don't care how you do it, but it just screws up the cap table royally. And one of the first things that a professional investor will say is, okay, clean up that cap table. I don't want all this crap in there. Clean that up. Then I'll invest in it. So just don't do it from the outset. Find some other way of doing it. Don't give out equity willy-nilly. Those are my inputs.
I just have a quick thing to add. Sorry, Laurie, I didn't understand your sweat equity question, so sorry about that. But absolutely, your team is by far the most important thing early on, especially our early stage startup, because your team's the one is going to basically take that idea and find a product market fit. And we went through 4 major iterations in the first year of our company, and it's absolutely important that you have the team who's willing to and who's have the capability of doing so. And so we award I co-founded with one of my college buddies, and when we bring on our early employees, we have one rule. And our rule is we're not going to bring anyone on unless that person has bring in some additional expertise that we do not have, collectively. So obviously this is not going to be scalable because there's going to be expertise overlaps over time. But because we value that person's expertise so much that we are willing to give up a lot of equity for him. So, and I think a lot of startups, traditional VC funded companies, they do not give more. It's like a senior software engineer, they do not give more than 1%. They don't. Sometimes they can give like half a percentage, a quarter percentage. In my opinion, that doesn't give me enough incentive to work for a startup. So I don't want to do the same thing to someone that I'm not even willing to do. For me, it's I want to award the person who is going to bring value to the company handsomely. So that's just a quick thing to add.
Great. So I want to open it up to questions from the audience.
Can you say something briefly?
Oh, sure.
And so we have heard all these good best practices, and we should just all remember that these are just best practices. But I mean, one of the things is if you are starting to build a Delaware corporation with the investor in mind, I think you're setting up yourself potentially for failure, because really there is no science of business. I mean, whatever you're doing today is specific to what you're doing today, and you can't really apply rules. It's good to know them and understand what's been done in the past to see whether it applies or not. But if you go out and you start building a Delaware corporation because you think, that's what the investor wants, well, you're already, preparing yourself to get the investor, and it may not be the best solution for you. Actually, maybe, because the customer is the best route, or there are other things. So, you close your options as you take these decisions to your business specifically. And that's very important to keep in mind.
Good point. So, question here.
Hi, Eric referred to hungry people willing to work for sweat equity. I'm looking for a tech partner. I'm probably going to be self-funded, and I have a pretty solid business plan and idea. With those assumptions, any suggestions for finding one, and what's the range of what I should give them?
Well, okay, so there's two questions. How do you find them, and then what do you give them, right? So the first one, how do you find a partner? From the great thing about the Valley, or I have found, having been here, and I think we all have been here a little while, so maybe we'll share our advice. Engineers congregate, and they congregate around technology. Food camps, bar camp, there's all these, whatever vertical you want to go into, there are engineers that are accumulating around the technology somewhere. Find them, walk around them. Amazingly enough, one thing I always do, whether I'm recruiting or whatever, is the bigger the company gets, the more they have talented engineers that quite honestly are ready for the next challenge. Right now I see a lot of ex-Google people who are ready for the next big thing. They've made their money, but quite honestly they're driven by technology. So literally go to where the engineers are congregating and walk among them. And if you've got a great idea and you've got the passion, you have the opportunity to find somebody, and you will clear a milestone in the path of doing it. So that's my recommendation: is network with friends. Find your friends and say, hey, I need an engineer who does this. I need a CTO. I need whatever. And then for how much to give them, are they going to be a co-founder with you? Are they going to be are they going to be your first employee? A co-founder, they come out of the founder pool. And I think I heard a number 15 to 20% for options for the employees. That's a number I've always been comfortable with. And you're sort of reserving 4 or 5% for warrants and other things that may, sort of overhead, because your banker and your lawyer are your best friends, remember. And that leaves whatever's in the founder pool. You've just got to start deciding how many founders from the beginning that you want, and how you're going to do the split. But if they're truly your co-founder, why not start at 50% and work your way down from there, right? But again, these are just guidelines.
Yeah, I've got some real firm views on that. It's extremely difficult to find a co-founder unless you actually know that person. So most co-founders come from your pool of people that you've worked with, which is why working for a big company can be a great advantage, and why I sold my first startup very quickly to the engineer I'd employed to do the work, because I realized I hadn't got a clue what I was doing. Neither had he. And so I went back to a big company to do two things. One, to learn about sales, marketing, finance, people management, blah, 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 blah. But also to make contact with people who I could maybe pick out as potential co-founders. And that's actually what happened several years later. If you don't know somebody, if you don't know how those people react under stress, so you've got a deadline to produce a product, is that person going to work 22 hours a day, sleep under the desk and make it happen? Or are they going to go home at 5 o'clock and say, tough, that's your problem? So, that's so difficult. We've been asked at SVB to hold co-founder dating events. And I've sort of wanted to do it because the idea sounds good, but every time I just back away from it, because all the experience that I've had and I've seen is that unless they're within the circle of people that you know, it probably takes 6 months, 9 months to working with somebody before you should feel comfortable enough to say, I want you as a co-founder, because you don't know how that other person reacts under stress. Some of the worst co-founders that I've seen are people who've been friends for years. I made that mistake once. Terrific friend, known the person 15 years. Hopeless as a business person. Completely unreliable. I had to fire the guy. So it's really tough.
I actually think somebody is doing a dating service. So if you go online and look for founder dating, there are some events around that.
Yeah, there are. Well, I think it's charged with
And
careful.
It is a good analogy too, because getting a co-founder is like getting married, right?
Yeah.
So now, you know, the percentage of divorce is pretty big.
that's why you have to
50%.
work left,
Or
or your
you're
best when you're
on a
right?
business, you know, because that's where the vesting makes sense, for example.
Investing is absolutely critical there.
You gotta be careful, yeah. I mean, there's a typical mistake actually that a lot of entrepreneurs do when they start is the warm body concept, which is, you know, you feel it's very lonely to be an entrepreneur, it's very tough, and you feel like you need a co-founder. Maybe you don't actually. You know, you should really think hard because it feels more comfortable to have a bouncing board, etc. But there are ways to get people to provide you feedback and help you without them being a co-founder. I mean, that's the whole point of these chapters I'm doing in Entrepreneur Commons is to have 5 people meet together so that you can have that bouncing board. And these guys have nothing to do with your business. That's the beauty. You know, all the advice you're going to get there is it's your problem, and you know, that's how I would do it, but you're on your own. What you see happening also as well is as they meet on a regular basis, they get to know each other, and one guy may decide that his project is not worth anything, and actually yours is worth better, and he'll go work for you, and that's a good way to do it, but it takes time. I mean, you have to build the trust over time. No way to make this fast.
I think we have time for one more question.
What you just mentioned, segue, like when you have a lot of companies, they try to build a board of directors and they try to give equity to the board. Like how real is that? How important is it? And should you give these guys equity, or should you just go to friends who really want to help you and try to get that?
Really easy. If you do a Delaware C corporation, one of the benefits of that is you only need one board member, and that can be you. You do not want board members. Board members are the people who actually have the fiduciary responsibility for the company, not the CEO. So they can fire you. So you don't want board members at this point. You want advisors, sure. So bring advisory people into you. And advisors should be people who want to advise you without any compensation, certainly in the early stages. If somebody says, I'll be an advisor for you, but I need 1.5% equity, say, terrific, thank you very much, bye. An advisor at that stage should be really excited by what you've got going and should want to be part to be an advisor, somebody you can call up. They're not going to tell you how to do stuff. They should be somebody you can call up on a regular basis without any compensation whatsoever. You get to a stage you get venture funded and you want to keep them as part of the advisory board, then you phone them up and say, you know, you've been a terrific advisor for me, I'd like to give you 0.25% per annum vesting on a quarterly basis.
And advisors also invest sometimes.
Yeah, I'm gonna run contrary to that actually. I advise and I won't join a company for free. From the perspective of I'm about ready to give you some, and there's different kinds of advisors. So again, this is an advisor. There are advisors where a Brad Feld. Brad will pick up the phone and take your call occasionally. But does that mean okay, it's the middle of the night and I need 4 hours worth of just nonstop help? Brad's probably not going to give that to you, but Brad may advise you, and you may be able to get him to do that, or someone from a Techstars. On the other hand, I think advisors are a great way as an early startup. I think at a point and a half, it's pretty rich. But at between a half a point and a point, if you can get an experienced Silicon Valley person to come in and do a bunch of work with you and for you, then for less than 1%, you've got a pretty good deal.
But that's not an advisor.
Well, I think, and this isn't, we were talking about this before we got started. I think that there's a new class of folks appearing in the Valley who have more money than time, but what time they have, they're willing to invest in startups. So you're right, maybe there's a new class of something happening. They do exist, and I think there's some value in giving them some equity earlier on. But yeah, are they advisors or are they something else? I don't know.
Can I add something? So to add on top of that, there should be 2 boards that you form initially. One is the board of directors and one is the board of advisors. However, the board of directors, when you're raising your first 25K, don't bother dealing with one until you raise your Series A, because it's just going to give you a lot of noise that you don't really need to care about. And at that point, you should be focusing on product, period. And in terms of board of advisors, I have a combination of both. So there are advisors that who are so prominent in the industry I'm working in, that I really want the time, they devote time in my company. So I'm willing to give equity for it. And a lot of time, these guys will ask for equity because they know how valuable their time is. But on the other hand, I've also worked with advisors who are just so passionate about what you're building, your vision is. They're willing to just, they love what you do, they love you, they love us, so they want to just spend time with you. And those are the best kind because you don't have to give up equity. but a lot of these are hard to come by. So if there are some industry veterans or like really, really prominent entrepreneurs who you really want to bring on as advisors and they like what you do, I think you should give up 0.5% of your company to just bring them on board as official advisors.
There's also the investors who are people in angel groups or individual angels who might want to be an investor in your company. They want to get to know you. And they'll be an advisor, free of charge, no equity, 3, 4, 5, 6 months. And if they like you, they like what you're doing, they like how you're making milestones, they might be an investor in your company and also introduce you to their angel group. That's a really good advisor.
Just to give my perspective on that thing as well, I mean, if an advisor is asking you for a percentage of a company, I would stay away from that person. I mean, you offer them if you think they bring value, but somebody who, even before you talk to them, will ask for something is, something's wrong, right? I mean, if they bring value, then you can be generous and give them something, but if that's a requirement, then you can talk to somebody else.
So I think in summary, the key takeaway is there are no rules. You have a lot of, there's more than one way to skin a cat here. And, at the end of the day, your company is unique to you. It's your business. It's your future. So, the best thing that you can do is network like crazy to get the best information, connect to people. Don't be afraid to share your ideas and to really, take the advice from a lot of different people, but make your own decisions about your business. At the end of the day, it's you that's moving forward with it. So I want to thank our panelists. It's been great. And I think that at the break, everyone will probably still be around, so if you want to exchange cards then, it'd be great. So thank you.
Thanks, Laurie.